Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Thursday, January 22nd, 2026, and this is episode 24. Today, we're diving deep into one of the most debated topics in the industry right now, multifamily. We're breaking it down by class, A, B, and C, and by the end of this episode, we're picking a clear winner for your 2026 strategy. Let's get into it. All right, let's start with our winner. What's hot? It's Class B workforce housing. This is, without a doubt, the institutional consensus trade for 2026, and the data is screaming it from the rooftops. First, Class B is actively outperforming Class A in rent growth, and all signs point to that trend continuing, if not accelerating, through the year. The core of this thesis is the affordability gap. In major metros, the price difference between a Class B workforce unit and a new Class A luxury unit is now averaging between $501 and $685 per month. That's not a small number. That's a durable demand driver. Tenants priced out of both homeownership and luxury rentals are staying put, which is why retention rates in Class B are significantly higher. We're also seeing the resurgence of value-add strategies. Institutional capital, which was sitting on the sidelines, is now flowing back into the market, specifically targeting Class B repositioning plays. They see the writing on the wall. America has a structural affordability crisis. The need for middle-income housing isn't cyclical, it's demographic. And regionally, look to the Northeast and Midwest. Class B properties there are seeing modest but steady rent growth, while completely avoiding the oversupply issues plaguing other regions. So, if Class B is what's hot, what's not? It has to be Class A luxury apartments, specifically in the oversupplied Sunbelt markets. The story here is one of indigestion. Too much, too fast. The South region's vacancy rate just hit a staggering 9.0%. Compare that to the Midwest at 6.6% or the Northeast at just 5.2%. The pain is real. Drilling down, urban core vacancy is now at 7.6%, even higher than the suburbs at 6.7%. All that new, shiny Class A supply is absolutely crushing urban operators. And this has led to a race to the bottom on concessions. Austin, San Antonio, Dallas, Denver, Nashville, Las Vegas, they're all offering 2-3 months free rent just to get heads in beds. For markets like Austin and Phoenix, most analysts agree it could take until late 2026, maybe even 2027, to fully work through this supply glut. For investors, this means compressed NOI, painfully extended lease-up timelines, and yes, the dreaded capital calls. And that leaves us with Class C. This is more of a mixed picture. On one hand, demand remains incredibly stable. Lower-income households are often less sensitive to moderate rent increases because they simply have fewer options. However, the operational risks are much higher. Access to capital for improvements is limited. Expense pressure from insurance and taxes is intense, and the risk of deferred maintenance snowballing into a major problem is always there. Class C isn't the worst play, but it's certainly not the best. You need to proceed with extreme caution and have best-in-class property management. So why does all of this matter? It matters because the multifamily market has completely bifurcated. Relying on national averages is misleading and, frankly, dangerous. The reality is this. Class B workforce housing, particularly in supply-constrained markets, offers durable rent growth, stable tenant demand, and access to institutional capital. Meanwhile, Class A in the oversupplied Sunbelt metros is facing a prolonged and painful absorption cycle. Asset selection and market selection are everything in 2026. Let's wrap up with the investor takeaway. It's simple. Class B workforce housing is the strongest, most defensible play for 2026. It has the affordability advantage, durable demand, and strong institutional backing. Avoid new-build Class A in Austin, Phoenix, Dallas, and Nashville until you see those concessions burn off. And Class C can work, but only if you have deep operational expertise and are prepared for the headwinds. Pick your class, pick your market, and underwrite conservatively. That's all the time we have for today. Thanks for tuning in to What's Hot and What's Not CRE. We'll see you tomorrow. And don't forget to like, share, and subscribe wherever you get your podcasts. For more insights, visit us at hotnotcre.com to learn more and subscribe to our weekly newsletter.